Hi guys, and welcome to the next lecture video of econometrics for data science. Let's jump into it because this one's going to be pretty dense. But today we're going to be talking about forecasting with systems. I'm going to use something that's very related to my research, so that's exciting for me. We're not going to get to, so this is going to be in two parts. We'll do another forecasting sort of time series type lecture in the next video. And that's going to get very close to what I'm currently working on, actually. I think I've mentioned this before, but I often work on energy related issues. So, one thing really quick off the bat I wanted to show you is that for your next homework, you're going to do a time series thing. You can look for whatever you want, but I just wanted to point to a couple websites that you can easily find time series data. If you have any interest in energy, you can come to the Energy Information Administration.gov, and they're still running, even though we're in a shutdown right now. But you can get lots of different data on all of these different types of energy related things. And then another one for macroeconomics, so things like inflation, GDP, interest rates at the state level or at the national level. This website called FRED, which is the website for the Federal Reserve Bank of St. Louis, has very good time series data. Because basically, for your next assignment, you're going to want to find observational time series data and basically do what I'm doing in this notebook. So, what we're going to do today is we're going to talk about what's basically referred to as forecasting with systems. So, the example that we're going to use today is we're going to use gas rigs, which means the equipment that's used to drill natural gas wells. So we can actually get data on that. And that basically data means is kind of a measure of the intensity of natural gas production at any given moment in the United States. And then we have natural gas prices. So we'd expect those to be related. In the very first lecture, we talked about supply. So when price is higher, we might expect production to be higher. Of course, we also would need to be concerned about endogeneity issues in that regard. But for now, we're not going to think about endogeneity with time series. And then also, we're going to have crude oil prices because oftentimes the same capital equipment rigs can be pointed at natural gas or oil or some a mix of both. My dog is chewing on a bone. Sorry about that. So, what we're going to do is first we're going to diagnose something called stationarity, which I'll define and discuss. Maybe you've seen that before with things like augmented Dickey-Fuller tests, which we will implement. Then we're going to explain and estimate a vector autoregression after deciding whether we're going to use levels for our vector autoregression or difference to data. And that's going to be based on step one here. And then we're going to generate a forecast. We're going to build off of this lecture in the next lecture to talk about something called co-integration and vector error correction models, which are very valuable sort of models to think about if you're going to be working with time series data. I think time series data also is kind of interesting in regard to kind of the differences and similarities between machine learning and what we get from econometrics and the mixes between those, because obviously we've already seen that where there's definitely value to and complementarity between those two disciplines. One thing that's tricky to think about with pure time series data is simply training and test data sets because it's not similar to categorizing customers or something like that, because that's probably going to be a massive panel or longitudinal data set that versus oil prices are one series of numbers over time. So it's not like I'm just going to go randomly split that sample into chunks for testing and training because there's probably a lot of time dependence going on in that data. But anyway, let's get to it. So to start out, I'm just loading and I'll give you guys this data set in the canvas so that you can run this whole notebook too, because you'll need this CSV file. I'm just organizing the data there, loading it into this package. And basically, this is a data set that has natural gas rigs, crude oil rigs. So those are the equipment is pointed at, and it's like how many are currently pointed at oil or natural gas. And then it also has oil prices and natural gas prices. I'm only going to be focused on using natural gas rigs, but you could play with the oil rigs with this data set if you wanted. That actually follows from my research. So my co-author and friend and I have a theoretical model showing that the microeconomics of this system, you really only need one of the sets of rigs because there will be some type of combination of oil rigs and gas rigs. So that like to identify the theoretical system of equations, we actually only need one of those sets of rigs in there. So by ignoring oil rigs, I'm following our economic theory. And I just wanted to let you know that, like, why isn't he using oil rigs in this? They are available in this data set, though. So now the very first thing we almost always do with, and then this is a good idea really with any data, but for time series data for sure is we want to plot the data. So I'm going to be using natural logs just to tampen down some of the volatility in some of these series. I'm also going to be testing for this thing called stationarity, and it's possible that tamping down some of that volatility will give us stationary variables, although that, as we're going to see, turns out not to be true, which is good because I wanted it not to be true for this example. And I knew it wasn't true since I've already done this before. But basically, we see here that we have the natural log of gas rigs. That's this line up here. Gas price is this down here, and oil price is this here. Now, there's a lot of adjustments just thinking of background. Like right now, I'm not using the same units. So this is barrels of oil. This is MMBTU, millions of British thermal units of natural gas. Some people will do things like convert both to, this is an energy content calculation. We could convert the oil prices to an energy content. Maybe if we wanted to do, maybe that would be a more apples comparison, but it kind of depends on your goal. Versus this is literally the number of rigs, but all of those again are in logs. So some key things to point out, if we look before 2009, so these crashes right here are both the 2007 through 2009 recession. 2008 is when that crash occurred. This crash in oil prices right here is COVID. This spike in natural gas prices right here is the Russia-Ukraine war. And the reason I point those out is because we could have a really nice, like, say we were just looking at this before 2009, we could have a really nice model that we already had set up and be like, sweet, we're just going to run this thing on autopilot because we figured it all out and we don't have to think about it anymore. And then the recession hits. Now, interestingly, fracking hits right about at the same time. Really, fracking kind of starts back in 2005, 2006, but it takes off, particularly in terms of natural gas production, in about 2009, right as we're coming out of the recession. And that's important because you can see that there's a widening of the difference between oil prices and natural gas prices after that period. Now, during this earlier period, the late 90s, we actually had a lot of power plants, so plants that generate electricity that used either natural gas or crude oil. Now, back then, these prices were held in check because if oil was cheaper on a energy content basis, those industrial electricity producers would choose oil to produce electricity. That would increase demand for oil, and then that would increase the price of oil. And then oil would become relatively more expensive compared to natural gas. If natural gas was less expensive, then those industrial electricity producers would use natural gas. So that action, that economic action, is what kept these prices in check. Now, fracking came along, and then that caused so a couple of things happened. First of all, oil was becoming so expensive that it basically just never made sense to generate electricity with oil anymore. So that what we call fuel switching started to die off. That was in part explained by the fact that fracking led natural gas prices to be much lower for a pretty long period of time here. This is about a 10-year period of time. So that switching behavior stopped holding the prices in check. At the same time, fracking took off and impacted both oil and natural gas markets. So Now we sort of switched the market. So where before it was the demand side that was switching between fuels, which one was more expensive. Now over here, we might have a situation where it's really more about rigs. If I can make more profits from oil, I'm going to point my capital at the production of oil. That will increase the supply of oil, and then that will decrease the price of oil. Similarly, if natural gas, I can make more profit, I'm going to point my capital equipment at natural gas, and then that's going to decrease the price of natural gas relative to the price of oil. So what I'm really getting at is there's a lot of issues in time series. These are issues that would not be easy to take care of with machine learning. Now, maybe once we have that system, that economic system in mind, the estimation part, maybe we can find ways to use really strong machine learning algorithms to get better estimates of what's going on. But I think this is a really key sort of place where both economic theory and econometrics can play a key role. And these are obviously very important things, like wars are fought over oil and natural gas, major geopolitical and business concerns related to those. I mean, think about costs and energy. Like these are two of the major ways we get energy in the United States. So hopefully that was a little bit motivating. So we're going to basically go through this and we're going to estimate how these series might move together. So first we need to talk a little bit about what's called stationarity and the related issue of spurious regression, and then testing for this thing called stationarity using the augmented Dickey-Fuller test. So we can say a weakly stationary process satisfies. So the expected value of y, and we have t there because we're thinking about time series data now, but then is mu with no t on it. So there's some fixed mean over time. And it doesn't really matter the sample I use, the expected value. This is a population expected value. It's a fixed mean. So we'd need that to be stationary. The variance of yt needs to be fixed to have a weakly stationary process. And then finally, the covariance between the current value and lagged values, depending on the lag distance. So if k was 1, this would be the covariance between the current level of y and the last level. That needs to be a constant. But also it needs to be constant for any gap, for any number of lags. So if k was 10, the covariance between the current value of y and 10 lags of y needs to be some type of constant. Now, this is even a weak stationarity is pretty hard to define in time series environments. And especially things in markets and commodities like oil, natural gas, inflation, for example, might follow a unit root process. So that means we have some situation like this where yt equals um, rho times its lag plus an error term. If rho equals 1, then the series is integrated of order 1. Now, if rho is less than 1, then this would be stationary because it would converge back. I'm sorry, the magnitude of rho is less than 1, then this series would converge back to these sorts of values, and we'd have stationarity. But if rho equals 1 here, then we have this being integrated of order 1, and this is actually a random walk in that case, by the way. And we say I1, so integrated of order 1. And what that really means is that yt, the level data, is integrated of order 1. It's not stationary. But then if we take the difference of yt minus 1, so how y changed over our 1 unit time period, then that will be stationary if we have an I1 variable. We could have I2 variables where you have to difference it twice before you get stationarity. And so then we need to check, okay, is y stationary? If not, we can difference it and check if the difference is stationary. If that's what we found, if the level is non-stationary, but the difference is stationary, then we would conclude that we have an I1, a variable integrated of order 1. So let's take a look at what this test does. We basically estimate this regression, the difference of our particular time series. And so then this is a regression on we're controlling for lagged differences, but then we're asking, Okay, does the lagged level matter? If the lagged level impacts this difference significantly, then we probably don't have a stationary variable. So that's essentially the test is checking this coefficient for statistical significance. Now, there's a variety of different, um, or sorry, I should say if delta equals zero, if this doesn't equals zero, then we have a unit root. But it should be negative because if we get a big shock to y, then we should get reconvergence towards our stationary difference. So here we use constant only version, so no trend. What I'm mentioning there is that the augmented Dickey-Fuller test has a variety of different specifications because we could believe like this one's probably no trend, but maybe we should be including a trend turn on the green line. Maybe even we should have a trend term on the blue line if we believe it's downward trending. But those are things basically we use visual inspection of the data to determine which version of the augmented Dickey-Fuller test that we should use. We're going to be using a constant no trend version. So the constant means the average is not zero. Trend means we kind of just have flat trends over time. Maybe a couple of those should have trends, but we're going to just be using the same stationarity, the same version of that augmented Dickey-Fuller. We might get different results if we use different versions of the augmented Dickey-Fuller test, because we might say have trend to stationary data. Maybe after we control for the trend, the data does satisfy these conditions of stationarity. So here we're going to just run those tests, just making a table right here to display the results. We have these three variables we're going to check. So natural log of gas rigs, natural log of gas price, log of oil price. Now notice none of those are significantly different than zero because remember, we're checking this coefficient and the rules are if it's zero, we have a unit root. So that means it's not stationary versus the alternative hypothesis is that this coefficient is less than zero, which means that it's stationary. So here we do get negative coefficients, but basically none of these are statistically significant. The gas price one is pretty close. It's significant at the 10% level, I guess, but we will difference anyway. And then we see, okay, these are much bigger negative numbers now, and all of these p-values are zero. So we're going to reject the null hypothesis of non-stationarity. And this is the first differences. So we did it in levels, and then we did it in first differences. Let's look back up here. Okay, if yt is integrated of order 1 and delta yt is stationary, then, or sorry, if yt is not stationary, really is how we should interpret this, and delta yt is stationary, then we have what's usually called a process that's integrated of order 1. So this strongly suggests that each of our series are integrated of order 1 because we didn't get significance when we did the levels. We did get significance when we did the differences. So I'm not going to go deeply over this because I kind of just did, but you just have some notes here when you're looking at this later for the interpretation of those results. And a reminder here that there are some different types of ADF tests. You could not include a constant, you could include a constant and a trend, and a variety of different things like that. So now we understand whether our data is stationary or not. We found all three series are integrated of order 1, so not stationary in levels, but stationary in differences. So then we're going to basically move on to our estimation of the system part of this. So a k-variable vector autoregression with p lags in levels is yt equals some coefficient matrix times yt minus 1, coefficient matrix yt minus 2, plus dot, 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 all the way down to that p lag. And then we have the error terms of this are going to be distributed mean 0. And then we have this sigma k matrix now. This is new. Usually we have the sample size here, but now we're thinking about this matrix in terms of the number of variables in our system. And so the number of variables in our system is 3. So this is just a 3 by 3 matrix in this expression, but we have to be careful when we think about that. Now, this is a vector autoregression. So although this is one equation, this represents a vector of three variables, and really this represents three equations in our system, or K equations in general. Each element of yt depends on its own past value and the past of all other variables in the system. So in our system, we'd say log oil price depends on the past log oil price, but it also depends on the past gas price and the past gas rigs. We can choose the number of lags just by using some type of assessment of fit. Probably that punishes us for overfitting, as all of these three criteria do. You've probably seen those before. Now, each AI in this is a K by K matrix of coefficients describing how each variable responds to the ith lag of all variables. For example, the first lag coefficient matrix for a three variable var, like ours is going to be a matrix like this. So we have these three times yt minus 1 for our first variable, these three times yt minus 1, 2, 3 for our second variable, and so on. Or sorry, so this is just for the first lag. So this is the lag of itself. So oil price on oil price example, gas price on gas price, gas rigs on gas rigs, for example. That's the diagonal element because it's the lag of the variable on itself. So remember, three equations here. One of them is oil price, one of them is gas price, one of them is gas rigs. So in one of those equations, we're going to have oil price. The first variable in that equation will be a lag of oil price. The coefficient on the lag of oil price and the oil price equation will be A11. The second equation will be gas price. So we'll have the level of gas price. A22 will be the coefficient on the lag of gas price in that second equation. Alternatively, in that first equation, again, oil price, A12 will be the lag of gas price in the oil price equation, lag of gas rigs in the oil price equation, and so on. So if the variables are integrated of order one and not co-integrated, then we want a difference before estimation is appropriate. Now, going back to our ADF and spurious regression, the reason that we need the difference is because if non-stationary variables, like the levels in our oil gas system, then we probably will get spurious results. So one example in macroeconomics would be like the price level. Prices are always going up over time. GDP, gross domestic product, is always going up over long periods of time. If we regress one of those on the other, we would get a significant coefficient because both of them go up over time on average. But that would not be meaningful because what we're possibly picking up, like, I mean, definitely inflation and gross domestic product are probably related. But if we were to ignore that both of them were non-stationary, we would get incorrect results related to that if stuff is just changing over time. So a funny and famous example of spurious regression, I think, is Nicolas Cage. So deaths by swimming pool drowning versus Nicolas Cage. We get this pretty strong relationship during the early 2000s. So I mean, clearly, if we regressed these two data on each other, we would get significant results. That is a spurious regression. Those are not related in the real world, but we would get significant coefficients, for example. We might be able to predict one off the other. Maybe that would be a good thing because we wouldn't necessarily care that there's no real relationship with them. However, that even would be spurious because the second that that correlation changes, that model would begin being not a good model anymore. Because my guess is that that relationship did not remain constant over time. It's probably that I think there's fewer Nicolas Cage movies now, but my guess is that pool drownings haven't fallen off as quickly as Nicolas Cage movies. I'm not an expert in either of those things, so that's kind of a guess. So if the variables are I1 as ours are and not co-integrated, and we want a difference before estimation. That's because, as I just explained, we would probably get spurious results if we did not difference before regression. If they are integrated of order one, so we're independent variables, and co-integrated, this is something we'll look into next time. The correct specification is a vector error correction model, or a VECM. We will cover VCM in the next lecture. So our three variable system, we have YT equals these three variables. Natural log of gas rigs, natural log of gas price, and natural gas log of oil price. A var P for this system is where we just are writing the first lags, but then we could have up to P more lags in this system. So in these dots, you can imagine going T minus two, T minus two, T minus two, T minus three, T minus three, T minus three, all the way to whatever P might be. Now, one thing I want to point out while we're right here, well, first of all, let's look at this. As I mentioned in our case, sigma k is going to be a 3 by 3 matrix. So what's in that matrix? Well, the variance of our first equation is the first diagonal element. The variance of the errors of our second equation is the second diagonal element right here. So the variance of these error terms and the variance of these error terms are the last diagonal element. So on the diagonal, we just have the variance of our individual equation errors. And then off diagonal, we have covariances between the different equations. That can be extremely important and will come up in the next lecture when we think about structural estimation, because these are called reduced form errors and they represent combinations of shocks between rigs, natural gas prices, and oil prices. But we might want to say, what happens if there's an oil price shock? For example, what if Russia starts a war and that causes an oil price shock or a natural gas price shock? Well, that means we're going to have to do some special math to figure out what happens to this system in those cases. And this matrix of how of those different error terms or shocks are related in the system is going to be important in terms of figuring that out. Finally, within this, like we could just consider that one of these equations on its own, and then that equation can have a big covariance matrix for its errors. So this is just a 3 by 3 matrix, but we could expand this to also include things like, well, maybe within this regression we have autocorrelation and we need to adjust for that. Well, then this would be a much bigger expanded matrix that would be T by T for each of our K variables. So think about that. This would be a massive matrix in this case because everything we've said about regression airs before a few lectures ago. I think much earlier, maybe the third lecture of the semester. The individual equations, we need to think about that whole lesson for individual equations. Now, in addition to that, we need to recognize that this is a system of equations and the errors might be correlated across equations in the system, in addition to error correlation within any of those equations, or heteroscedasticity within any of those equations, or and so forth. So that's just in general a vector autoregression in levels, what that would look like. But because we found above that our variables are not stationary, we want to difference our regression to avoid spurious regression. So we can just difference our system, and then this is what our three equations look like in that case. They're going to have different errors, and we need to label the coefficients differently because the coefficients are going to be different on the differenced version of this regression. But really, everything is basically the same about describing what this system looks like. The main key is that this is the difference version of the regression to avoid spurious regression. So here we go. We're going to just difference the data and fit a vector autoregression right here, and we can look at the results. So different information criteria available to you. And then we can kind of just look, okay, and remember, we have three different equations. So for our gas rigs equation, we have gas rigs increase when the lag of gas rigs is higher, then gas rigs tends to be higher. That's statistically significant. Similarly, when the oil price, interestingly, is higher than gas rigs are higher, that's statistically significant. Gas price, however, does not have a statistically significant impact on gas rigs. Now, that could be, you guys don't study energy markets as much as I, but this is sort of reasonable to believe because the vast majority of oil wells I should say the other way, the vast majority of natural gas wells produce at least some types of oil or liquids that are substitutes or can increase crude oil production. So it's not all that surprising that people would drill more gas wells and maybe hope to try to get some of those liquids production when oil prices are higher. So then, of course, we have two more sets of results. Here, it's only gas prices that impact gas prices significantly, and it's only oil prices that impact oil prices significantly. That's in this system. We're going to go into next time that this is probably misspecified because we do probably have co-integration, which is going to be, and we probably should be using a vector error correction model, but we want this vector autoregression background before we can get too deep into that part. And then we can look at the correlation between the errors across, because this is basically our estimate of that sigma matrix. Because remember, that's the variance across but the variance is backed out of this, so this is just the correlation. So this doesn't have the variances on diagonal, but it does have the real estimated relationships between the correlations across. So these covariances, but the correlations rather than the covariances. So just giving us a view of what that matrix might look like. Now, it's usually a good idea to take a look at the residuals from our difference var to see if anything crazy is going on. These look pretty stable and pretty good over time. No crazy looking autocorrelation, for example. Like if the orange line was always above zero and then always below zero, we would be skeptical of the existence of autocorrelation there. This is pretty crazy. This is from COVID, so massive decline in oil prices, followed by the bounce back as people stopped freaking out quite as much about COVID. But the initial, you may remember, oil prices for a few days, these are monthly oil prices, so they don't go negative in this data set. But for a few days, oil prices actually went negative as COVID was coming on. But generally, a good idea to look at the error structure over time in any time series analysis. Finally, oftentimes we're interested in forecasting when we're thinking about time series data. So we have data from January 94 to April 2024. And what we can do is the VAR predicts future changes because it's a difference vector autoregression. So we could predict y hat, t is our last time period plus h. So if h is 1, we would just be predicting one time period out. So we just put yt and then we add our estimated difference because we are estimating differences with our difference autoregression. We have to do some things to make sure we're getting the actual levels. I mean, we could just have predicted the logs, but it's often nice for clients, for example, because the client probably doesn't want to look at the natural log of oil prices. They want to look at the actual ones. So we just do some work to get back our actual prices. We have to be a little careful with that if we want to do any type of confidence intervals or anything, because there's going to be some weird nonlinearities in that transformation. But so basically, I'm just making a very simple forecast plot. There's nothing that crazy going on here. And it makes sense that nothing's going crazy on here because we differenced our data. We have stationary data now in our differences, so we're not getting crazy action to the right. Now we have this is our actual data. It ends in April 2024, and then our forecasts start in May 2024. So you're going to walk through basically, I want you to find data, time series data. Here's two places you might check, but there's many other places that you guys can find time series data. Um, and you're going to basically walk through this same process. Next time we'll do vector error correction models, which is nice because we can more maybe rigorously include theory, whether it's economic theory or other systems theory, like we talked a lot about endogeneity and systems equations. That's where theory comes in. We're going to show how what I mentioned really at the beginning, looking at this plot where we only need one series. So I have an analytical model that shows we should be able to have a closed system here with one of the rig series, either oil rigs or gas rigs, and the two price series. And we can find what's called co-integration and then probably get an even better model than what we're seeing here. All right, so let me know if you have any questions about the next collab assignment, and I will make sure you guys have access to this data so that you can run this collab as well. Okay, see ya. See you again.